Welcome to the RiverNorth Core Opportunity Fund 2014 Fund Review. My name is Alan Webb, and I'm a member of the Portfolio Specialist team at RiverNorth. I'm pleased to be joined today by RiverNorth Chief Investment Officer and Fund Portfolio Manager Patrick Galley. Patrick, thanks for being with us today.
Thanks, Alan.
So Patrick, before we get into 2014 performance, can you talk a little bit about the fund strategy and maybe highlight a couple of key features of the fund?
Sure. The RiverNorth Core Opportunity Fund, that's our flagship strategy. We launched it in 2006. We came out with a balanced approach, a flexible asset allocation approach, which allocates amongst most asset classes. But the risk profile that we try to target is really a 60% equity, 40% fixed income, which means that the beta to the S&P 500 is typically around 0.55 to 0.65 to the S&P 500.
So is there anything magical about that beta target, or is it simply just fallout from your 60-40 equity fixed income allocation?
Well, when we were coming up with the fund strategy out of the gate, we thought a balanced approach fit into most allocators' asset allocation and their clients' portfolios. So it also gives us the most flexibility to take advantage of the opportunities in the closed-end fund space, because virtually you can get access to every asset class by investing in closed-end funds. So if there's an opportunity in equities, we can allocate towards equity-based closed-end funds. If there's an opportunity in fixed income, we can allocate there.
So if I'm thinking about some short bullet points about the fund, multi-asset class, meaning equity, fixed, and cash exposure at all times, roughly a 0.6 beta to the S&P, and 50 to 70% closed-end fund exposure on average.
On average, correct.
Great. So turning to 2014 performance, the retail share class of the RiverNorth Core Opportunity Fund was up 6.28%, with the S&P up 13.69%. So can you comment on 2014 performance and any factors that may have helped or hurt?
Yeah, the first most important factor is probably the S&P 500 on a standalone basis did very well. If you compare the S&P 500 compared to most asset classes, it was the top of its class. So it was hard to outperform S&P 500 on a standalone basis. If you invested in the S&P 500 excluding Apple alone, you would have actually been down, you would have only had 90% of the return of the S&P 500. So Apple made up for 10% of the return on a standalone basis of the S&P 500's return in 2014. So what that means is a diversified portfolio allocating across various asset classes actually underperformed. But we think over the long term, a diversified, balanced approach produces better risk-adjusted returns. So diversification hurt us in 2014, but we think on a risk-adjusted basis, it proves well on a long term.
How about performance as it relates to closed-end fund discount movement last year? As we've discussed in some other videos, closed-end fund movement was relatively small last year. So it seems like a year where asset class performance probably trumped closed-end fund discount premium movement. Is that a fair statement?
That's a fair statement. Yeah, discount volatility was not as great. Discounts really stayed wide. Relative to 2013, there wasn't a lot of volatility. They just stayed absolutely wide and didn't narrow significantly. In fact, a lot of the fixed income closed-end funds widened out even more than where they started the year.
So turning to longer-term performance, the retail share class of the Core Opportunity Fund has returned about 8.42% per annum since inception, where the S&P has been about 6.96% per year. So why the sea change in a little better performance since inception, although a little worse performance in the most recent years?
So I think that it's all attributed to diversification. So that's getting back to the fact that the more diversified the portfolio is going to take the bumps out of the road on the downturns, where the diversification helps. But when it's a straight bull market, especially in equities, you're going to underperform. So we think diversification, again, over long market cycles is better, and then we're clipping away at the alpha that closed-end funds offer from discount narrowing. So we think that alpha adds up over the long term as well. To put that in context, if you look at our since inception performance compared to every single asset class out there, I believe gold is the only asset class that's outperformed us. So it means hitting singles and some doubles once in a while on a consistent basis proves well over the long term.
Patrick, turning to the portfolio, any major portfolio changes or allocation shifts in 2014?
Nothing major from an asset allocation standpoint. 2013, we had a relatively larger shift where we started allocating to fixed income closed-end funds. But as I said before, fixed income closed-end fund discounts remained wide, so we kept that allocation at a more elevated level. As far as closed-end fund exposure goes at the fund, we started the year approximately 84% allocated to closed-end funds, ended the year at 74% closed-end funds, but we also got down as low as 58% allocation to closed-end funds. So the tactical allocation within closed-end funds did swing quite a bit, and we ended the year above our 50 to 70% typical allocation.
To close the session, since obviously we're doing this via video, not via webcast, I thought I would ask you a few questions that the portfolio specialist team gets frequently from Core Opportunity Fund investors. So Patrick, adding to your thought, the current fact sheet shows more than 100% exposure to the market. So does that mean the fund is levered, or does that simply mean that you have more than 100% exposure to the market and that you and your team are comfortable with that exposure?
Yeah, we don't use leverage at the fund level, but as most investors know, closed-end funds typically implement leverage in their structure. So we look through to that leverage when we're doing our fact sheet and any additional exposure we might get from the closed-end funds that are implementing leverage. So from time to time, we might be over 100% because of the underlying leverage that the closed-end funds use. Fourth quarter was a good example. Typically, there's tax loss selling going on in the fourth quarter where we thought it was a good opportunity to increase our closed-end fund exposure. Given the balanced nature of the fund and the diversification, a lot of that, the asset classes are negatively correlated. So we think it's a good risk-adjusted return to increase closed-end fund exposure, not necessarily take on more beta at the fund, but take on more discount risk, which that discount risk is really our opportunity.
Question 2, we frequently are asked, how do you come up with your asset allocation? Is it simply the exposures that come out of the closed-end funds that you select, or do you have a top-down asset allocation and then go out and try to find closed-end funds to fit into that asset allocation?
Yeah, we start with a strategic asset allocation and optimized portfolio where since 2006, it's really kind of our home base. But that said, we're never our home base. But it gives us a good risk framework to manage our asset allocation around. So we're not making bets on asset classes from an asset allocation call perspective. So we will let closed-end funds dictate some tactical shifts from our strategic allocation, but the margin of safety has to be there from a discount perspective. If we're making a tactical shift in certain closed-end funds in a specific asset class, we typically counterbalance that additional exposure that we're getting somewhere else. So for example, if we're increasing high yield exposure, that's highly correlated with equities, we might beta adjust the portfolio by decreasing our equity allocation.
Understood. So keeping all this inside the framework of roughly 60-40 from the top down.
Correct.
Regardless of the underlying.
Looking at the overall correlation and beta of the fund and keeping it in line approximately 0.55 to 0.65 to the S&P 500.
Gotcha. Last question. We get a lot of questions about yield. All the other RiverNorth mutual funds publish a yield, and certainly our investors realize that there is an attractive yield component frequently attached to closed-end funds. So why is there not a yield published for the Core Opportunity Fund?
Well, when we started the fund, we came out with obviously more of a balanced approach, an asset allocation approach, and we wanted investors to be focused on total return. We actually think probably the one biggest inefficiency in the closed-end fund space is that investors focus on closed-end funds for yield purposes and forget about total return. So RiverNorth has a total return mind or investment focus versus trading against investors that have a yield focus. That presents opportunity and inefficiencies that, frankly, we're taking advantage of. So if we had our investors focused on a yield on a monthly basis or quarterly basis, and we all of a sudden decreased the yield or distribution because closed-end funds weren't as attractive, maybe the investors would have the same focus that they have on closed-end funds. So we want them to be focused on total return versus yield.
Patrick, thanks for your time. We really appreciate your comments on the Core Opportunity Fund today.
Thanks, Alan.
So with that, we conclude the 2014 market review for the RiverNorth Core Opportunity Fund. As a reminder, the retail share class ticker is RNCOX, and the institutional share class ticker, which was launched in August of last year, is RNCIX. For additional information, please go to www.rivernorth.com.